Okay, let's turn now to the key property sectors. We're going to start by looking, as we do each of these presentations, at the CBD office market. The key driver here, of course, is white-collar employment growth. And similar to the economy, we've seen a rapid deceleration in employment growth in Queensland, as you can see on this chart. Queensland had been driving the nation in terms of the rate of growth in employment. That's continuing to be the case, but obviously at a much lower level. The assumption is that 2010 is going to continue to be quite a low level of employment growth in Queensland before you start to see a more pronounced pickup in 2011 and then back into the sort of regular levels of growth from 2012. So I think that's really a pattern to remember because our forecasts for the demand side of the office market tend to follow that pattern. I guess there's one key thing that stands out when we analyse what's happened and therefore what's going to happen in the Brisbane CBD market. If you look at the chart of the net additions, meaning the amount of stock built minus that's been taken out, well, really this chart says it all. 2009, we saw it coming. What we didn't see coming this year was the fact that business would contract at the same time that a lot of new buildings were coming into the Brisbane market. And of course, it's going to take time now to overcome the delivery of such a large amount of space in a short period of time. We think the demand for office space in Brisbane will follow a pattern like this, not dissimilar to that employment chart I showed you a moment ago. So levels of net absorption will remain positive in Brisbane, but will be below average this year and next before starting to pick up in 2011. And of course, the pattern has been set now for vacancy rates, and we think vacancy will hit a peak of 13.7% next year before starting to gradually come down again. So we're not really forecasting at this point a sort of a rapid decline in vacancy, but a gradual. That's very important because that really tells us how rents will respond as well. So remember that pattern. It's an important one for understanding also what's going to happen to rents. Now, this is our forecast of rents. We know that net face rents in Brisbane increased 90% between 2005 and 2008. Effective rents increased over 120%. So our forecast suggests, and a lot of this isn't a forecast anymore, it's happened during this year, that rents will fall somewhere between 20 and 30%. So there'll be a legacy left there. Rents will still preserve about 60% of that increase in the last cycle, but clearly that's a pretty massive adjustment, one of the largest in Australia, given the vacancy rise we're forecasting here. And that rents really don't start to pick up again, and pick up only very gradually from 2010. That's because the vacancy only starts to come down very gradually from then as well. So turning now to the pricing situation, our quote of yield has been complicated like it has around the rest of the country and indeed around the world by a lack of transaction evidence. But we're now quoting prime yield indicative yield in Brisbane at just over 8%. In a range is probably between 8 to 8.5. We think that's sufficient to put the sort of risk margins back in to the long-term cost of debt. But as Bruce points out, upward pressure now on interest rates will mean that that margin is going to be challenged again very soon, and raises the question of whether yield might need to move up further in response to that, or whether the risk margin will be enough to accommodate that rise in the long-term cost of debt. That's one of the key challenges, I think, for 2010. Interestingly, the long-term yield in Brisbane is about 7.5% if you go back over the last 20 years. So we're well above that now. So the pricing is certainly adjusted significantly, and leaves the opportunity for purchasing is clearly there now if you can see your way through the outlook on the fundamentals. Let's have a look at the near city market. At the end of the day, it's not a dissimilar pattern to the CBD, but for slightly different reasons. The net additions to stock, well, the peak is past now in the near city, but there's still a couple of big years of completions yet to go this year and next year. We think the demand side has tended to follow very closely supply because of the high levels of pre-commitment in this sub-market. We do see a negative year this year before demand starts to pick up gradually from 2010 and get back to roughly the sort of longer-term averages or a little bit below that. But the vacancy rates, of course, will reach a peak not dissimilar to the CBD, just over 14%. So it means a similar story to rentals, with rentals falling similar level to the CBD, but I think the rents really maintaining their gap, and this is in terms of the dynamics of the two markets. The 30% difference you find between the CBD and the near city has been remained as the rents moved up, and also as they've moved down. So it does create that dynamic of tenants looking for lower rentals. It's still possible to find those in the near city. Let's summarise the Brisbane outlook overall now before we'll chat to some of our local professionals. The demand-side contraction in the office markets we think is now largely done. We expect, though, a recovery which is gradual in nature. The supply peak is over from 2009 and 2008 in the near city. Total vacancy to peak about 14%. That is now officially the highest peak in Australia. Effective rents to grow from 2011, and the falls, importantly, are not as great as the recent increases. Repricing is now largely done. We think yields will start to stabilise into next year. So that gives you a bit of a wrap-up on our outlook for the office markets.